Good afternoon. This is Ed Wilkin with the accounting firm of Wilkin and Guttenplan. I'm a shareholder with the firm, and we're going to do the webinar today on FHA requirements, what boards and property managers need to know. Just again, a reminder that once you've logged in, you can either use the speakers in your computer or you can actually call on your phone, and the number is, again, the dial-in number is 1-702-489-0001. The access code is 960-386-899. All right, again, welcome. And we're going to start now. What we'll be covering today is the focus will be on owner-occupied, substantially completed projects. The program is going to be applicable to condominiums, and our panel of experts are Ron Pearl and Phil Sutcliffe, and I will be the moderator, Ed Wilkin. The first thing I'd like to do, you'll have a polling question that's going to come up. I want to get a little bit of background on what the audience is, so if you could check off the box, I'd appreciate it. We'll give you a minute or two to do that. Okay, I see the majority, it looks like about 2/3 are property managers, about 20% board members, and 15% professionals, and 8% others. Again, I'm going to turn it over now to Phil Sutcliffe. No, we're going next. So a bio on me. So the background again, FHA provides mortgage insurance. A lot of people think that FHA is actually the the organization or entity that lends money. They provide mortgage insurance that protects lenders against losses as a result of homeowners defaulting on their mortgage. So it's an insurance product that the FHA actually provides. Today, approximately 35% of the condo loan market is through the FHA program. Over the past 10 years, the amounts loans within the program have gone from 273,500 to up to 729,750,000. Market share has increased from 9% 5 years ago, as I mentioned, 35% today. Interest rates are generally better through the program, and mortgage insurance companies in the crisis that credit crunch that we went through recently, all but completely pulled out of the market, and only recently are they beginning to re-enter. So it's still a very important aspect to providing loans to buyers in condominium projects. As far as the marketability, approved projects appeal to 100% of the condo market. Again, as you probably know, the down payment requirements are less than a conventional mortgage, which allows more buyers to qualify. And again, then giving your owners the ability to probably sell their unit in quicker and easier in finding financing. Existing homeowners in refinancing will have lower interest rate loans, lower payments, more cash flow, less burdens to pay your monthly maintenance fees, and hopefully be able to keep them in the unit even if they have issues with their cash flow. And again, the ability to sell units increase. I'm now going to turn the program over to Phil Sutcliffe. Phil is with the company Project Support Services, LLC. He does a lot of consulting with builders, lenders, attorneys, management companies, and condo associations to coordinate the FHA and/or Fannie Mae project approvals for condominium. It's extremely busy, works in Pennsylvania, New Jersey, and New York. Phil, I'm going to turn your program over to you. Oh, we have another polling question coming up. If you could just take a look and read this and give us an idea of what your chief concerns are with obtaining FHA financing approval. Okay, it looks like the majority of you are concerned about the complicated paperwork, so that's actually perfect because that's one of the things that Phil's company does is help you get through the paperwork. So I'm now going to turn it over to Phil. Phil?
Thank you, Ed. One of the primary issues that we run into with regard to FHA approval of a condominium is whether or not a project's even eligible to be approved by FHA, and that's what we're going to be discussing later on in this session. There are several issues that FHA is going to look at as part of an underwriting decision when a project is being reviewed, and they range from legal issues that could include a variety of different things, including leasing restrictions, deed restrictions, and the like. Financial stability in terms of a review of a budget, financial statements, balance sheets, and the like. Adequate insurance, making sure that the property carries the adequate amount of insurance as required by FHA. My colleague Ron Pearl will be handling that more as we get along further into the webinar. Some of the things that we need to start looking at, and before we even get involved with a project, one of the things we want to make sure that we're aware of is whether or not we have any red flags or any concerns about whether or not a project is going to be eligible. Things like owner occupancy level, single ownership by one entity, if there's any current litigation, and we'll discuss litigation a little bit more in detail later. Delinquency, high delinquencies on condominium association dues, allocation to replacement reserves, and again, we'll get into a little bit more detail as we go along. And inadequate fidelity insurance coverage. In our review of many projects, one of the things that we've discovered most of all is that while they may have adequate property and liability coverage, a lot of times there's inadequate fidelity coverage. And FHA's requirements on fidelity is based on a formula that they use to determine what's the appropriate amount. There are going to be some costs involved. It all depends on the approach that you're going to be taking. I, as a project approval consultant, we've done this for, well, 20-some years, and our role is to work with a condo board, management company, and the like to make sure that they have everything that they need in order to be able to get approval. And therefore, as an outside consultant, I wish I could say that I was doing this because I enjoy doing it, but I do charge fees. There is conceivably going to be legal reviews. When we talk about a legal review, one of the things that we need to understand is that one of the documents that FHA requires a submitter to sign, and Ron will be discussing this a little bit later, is what's known as a project certification. And one of the first items in the project certification is a stipulation that the condominium exists in full compliance with all applicable laws. That's not something that anybody is prepared to make a decision on and certify to FHA on without having someone confirm that the legal documents comply and that the condominium is in compliance with the applicable statutes. Lenders' cost, I don't know, typically a lender, most lenders that we are involved with, this is usually not something that they want to get themselves involved with, quite frankly, because lenders are, quite frankly, they're in it for the end loan business. And with the amount of work and paperwork that's involved in the submission, most lenders are, generally shy away from it. If a lender does get involved, it's likely that they may charge a fee for their review or their processing of the project. Once FHA gets a package, a completed package from us or from a submitter, their current turnaround time is about 30 days from receipt of completed package. What's not on the slide, of course, is the question about how quickly can you accumulate the necessary documents for a submission and have it ready to submit to FHA. That's a bit of a wild card because it depends upon a variety of things. One is the cooperation from all parties, whether it be the board, management company, attorney, and the like. We, of course, always expect that everybody's going to fully cooperate. But then the other is availability of documents. Some of the documents that we need for a submission, and we'll go into some of this in a little bit more detail, but some of what we need should be readily available. Some of it may require a little bit of research and going to courthouse and get documents and so on. For example, FHA does require, as part of a project submission, that we provide them with copies of all recorded condominium legal documents. That would be your master deed or declaration with the bylaws, articles of incorporation, surveys and plans, and any amendments that have been filed to the master deed or declaration since inception. For projects that are older, and we are working on some projects that go back to the 70s and early 80s, finding those legal documents sometimes can be a little bit of a challenge. And at that point, we have to recommend to the condo board or manager that they may need to enlist the services either of a title company to research it or their attorney to look into the public records. And again, that can affect the time frame for accumulation. But once FHA has a package from the submitter, they generally render a decision in 30 days or less. So let's talk about some of the eligibility issues. For the purposes of this particular webinar, we're dealing with condominium projects that are fully established, sold out, resale type projects, 100% completed. Just as a brief backtrack on history, one of the things that has created the most havoc, to use that word, within the industry, realtors, management companies, and so on, is that up until December of 2009, FHA did not require that projects be approved if they were fully completed. They were able to, lenders were able to do loans on what they call a spot loan, and FHA terminated that spot loan program 2 years ago. And it's left situations where projects that heretofore were doing FHA loans for many years could no longer do them because their project was not on FHA's approval list. So eligibility, one is it's a completed project. There's an owner occupancy requirement. Generally, FHA requirement stipulates that at least 50% of the project has to be owner occupied. That can infer that the other 50% could be investor owned. However, please note that FHA does have a restriction that limits the number of investors in the project to the 50% and also limits the number of units owned by a single entity to no more than 10% of the project. So if you have a project where you have 50% investors, you would be okay unless you have a single entity that owns more than 10% of the project. On the issue of square footage is predominantly an issue with regard to mixed-use projects. FHA has a cap or limit on project eligibility that says that a project must be homogeneous with residential use. I'm not sure how to describe that term, but it has to be predominantly residential in nature. The square footage allocated to non-residential or commercial use is limited to 25%, but they do offer an exception for established projects, which is what we're talking about here, established projects up to a maximum of 35%. But again, the kicker with the 35% exception is that it is, again, a fully completed, fully annexed, sold-out project where the unit owners are in control of the board. There are requirements on delinquent assessments. Delinquent assessments are based on the number of units in the project, not the dollar amount of the assessment. You could argue the validity of that if someone has a huge delinquency and it's affecting the budget, but FHA's guidelines stipulate it's purely based on the number of units. And FHA stipulates that no more than 15% of the unit owners in the project can be delinquent more than 30 days on assessments. Now, currently, I know in the last several months, CAI has been working with FHA to try to get that 30-day change to 60-day. I'm not sure if they've had any success with that. But the delinquency ratio for 15% also includes bank REO. And that's important to know if you have high REO in your project because sadly and unfortunately, lenders in foreclosure have a tendency not to pay their condo fees figuring that they'll just wait until they sell the unit and then make up for all the deficiencies when they sell the unit. That, unfortunately, can work to the disadvantage of an eligibility for a condominium. FHA does have certain provisions with regard to leasing restrictions. They stipulate that you're allowed to have certain restrictions in your project. However, you cannot have a restriction that stipulates that no units can be leased. In other words, if you have a total prohibition against leasing in your project, the project is ineligible. They have stipulations on minimum term. No less than 30-day leases are permitted. They do require, or they do allow, I should say, the condo board to require that a tenant abide by the rules and regulations, that the association is entitled to a copy of the lease, and so on. What they don't allow is a situation where the condo board has authority to approve or disapprove a tenant. That type of right of first refusal with regard to leasing restrictions is prohibited. So, and that includes a review of creditworthiness standards or anything in that nature with regard to a potential tenant. FHA calls that a restriction on conveyance according to the CFR, and under those guidelines, a project with those kind of restrictions would be ineligible. That harkens back to the issue of cost as well. If you have a project that wants FHA approval and has that kind of language in their documents, it will require an amendment to be filed to cure that deficiency in the documents. They're going to be looking at your budget. The current standard, the minimum standard, is that at least 10% of the annual budget is allocated to your replacement reserve account on an annual basis. That 10% is based on allocated assessment income, not operating expenses. So typically what we do when we're working with new builders and new projects is we tell them to first determine what their assessments are, take 10% of that, put that into your budget, and then work around that for the rest of your operating expenses. Insurance, they're going to be looking at a variety of things in terms of property coverage, liability coverage, fidelity or crime coverage, and flood insurance coverage. And again, Ron will be discussing that with a little bit more detail.
I just want to mention in here that if you have questions, we're going to deal with the questions at the end, but you'll see on the right-hand side of your screen a place to type messages in. Please type in your questions, and we'll try to get to as many of them at the end of the presentation. Thank you.
Thanks, Ed.
Yep.
Challenges. There can be multiple challenges. Not every project is perfect. We wish they were, but not every project is perfect. Some have issues that we need to address. The issues of special assessments, litigation, and loans are not necessarily deal breakers, but they do have to be addressed, and they do have to be addressed satisfactorily. A special assessment, for example, that is being done and shows, if a project shows a history of special assessments over the last few years, is going to have a potential problem because a special assessment can, in some cases, indicate poor budgeting on the part of the condominium association where they're not collecting enough in order to handle either operating expenses, deferred maintenance, or a reserve replacement. Litigation is a concern. If it's litigation for the collection of past due assessments, that's fine, that's acceptable. That kind of litigation is not a problem. Where the problem is litigation in terms of lawsuits against the board members and things like that. If there's a simple slip and fall type litigation, as long as it's being defended by your insurance carrier, you should be okay. Where we see litigation the most is where there's these projects that are now under unit under control from the developer. And the reality is that, as I like to say, you can't have it both ways. You cannot sue the developer for defects in workmanship in your project and then at the same time tell FHA that there's nothing wrong with your project. So if you're going to be having any kind of lawsuits or litigation surrounding the issue of defects in workmanship or problems with work done by a contractor or whatever, FHA will insist that that litigation be solved and any work as a result of the litigation be completed. You can't just say that you have enough money in the bank to cover whatever repairs or renovation work needs to be done. FHA will want to see that the work is completed. Deed restrictions. affordable housing deed restrictions. FHA has a provision in their guidelines that stipulates that if your condominium has embedded within its master deed or declaration a requirement that a certain number of units, specified units, are set aside for affordable housing in accordance with a local community or countywide affordable housing program, FHA specifies that the provisions of the affordable housing deed restrictions have to terminate in the event of foreclosure of a unit. Essentially, FHA is saying if the foreclosure and the lender takes the unit back, they have to be able to resell the unit at market rate. FHA used to say if you had affordable housing restrictions that didn't terminate in the event of foreclosure, that the entire project was ineligible. Fortunately, they've changed that policy where now they say if they don't terminate in the event of foreclosure, then FHA will still approve the project, but they will exclude the identified units that are subject to the affordable restrictions. So you'll still get your approval, but we would have carved out for those affordable units. The irony and the shame of that, of course, is that an affordable housing deed restrictions are typically the buyers who need an FHA loan the most. However, if the restrictions don't terminate in foreclosure, then essentially you're out of luck. In a project certification, we'll be going into that in a little bit more detail in specific language, but when a lender or a consultant such as myself submits a project, they are including in their certification that confirms that the project complies at all regards with regard to FHA's eligibility criteria, that the condominium exists with all laws and so on. Again, Ron will be going over some more specifics on the language on that later. And again, insurance requirements in terms of challenges, it's a matter of reviewing your current coverage and making sure that it complies with FHA's requirements. With regard to special assessments, when we get a project that has special assessments, we of course need a detailed determination, the usual who, what, why, where, and when. We need to know what the purpose of it was, when it's due, whether or not it's going to have any effect on financial stability. Whether or not it has any future impact on value or marketability is one of those things that's pretty tough to tell. But the reality is that there are special assessments in the wonderful, sunny, warm northeast part of the country in the winter, special assessments for excess snow removal, this past winter notwithstanding. Excess snow removal is not an uncommon special assessment and generally speaking isn't a problem. Special assessments to replace roofs in the community may indicate to FHA inadequate reserve funding because that's what your reserve fund is for. And so there's going to be a special assessment review to make sure that it does not have any, lead any discussion on whether or not the project is adequately funded in terms of fixing and repairing things. As I said earlier, litigation, foreclosure actions don't necessarily have an impact on that, but if there is a party to a lawsuit, we still need to have that disclosed. That does go back again to the lender, to the legal review, and the possibility is that legal reviews are possibly going to cost money, even if you have an attorney who's working a litigation for you. Same thing with special assessments with regard to litigation. You need a detailed explanation of why, what the settlement or expected settlement date will be. If there indeed is sufficient insurance coverage, again, a slip and fall type of litigation, and the insurance agent is willing to confirm that they're working on contesting that, that usually will not be a problem. Anything that would impact an ability of an owner to transfer title, they'd be something like mechanics liens and things of that nature. Those obviously could be a potential problem as well. We have talked about deed restrictions, and again, the project with deed restrictions is that the deed restriction cannot survive foreclosure. That's an important aspect. That's it for my session. I'm going to now turn it back, turn it over to Ron, or turn it back over to Ed.
We can turn it over to Ron, but I'm going to give a little background on Ron. Ron is a partner with the law firm Wallack. in Princeton, New Jersey. They also have an office in Pennsylvania. He's in charge of the firm's Community Associations Practice Group. He concentrates his practice in the area of community associations, law, transactional real estate, eminent domain, and tax appeals. Ron has been involved with CAI both on a local level and national. Ron, it's all yours.
Thank you. Thanks to Wilkin and Guttenplan for inviting me to participate today, and thank you to the audience for signing in. My portion of the presentation will cover insurance requirements, disclosure requirements, the dreaded project certification, the potential legal liabilities arising from the certification, and finally, issues relating to association transfer fees, such as capital contributions or membership fees. The project guidelines require that the project be covered by hazard, flood, liability, and other insurance required by state or local laws or acceptable to FHA. The association is required to maintain a master policy covering 100% of the current replacement cost of the condominium, not including the cost of land, foundation, excavation, and other items normally excluded from property coverage. Obviously, land is excluded because in the event of a casualty, the land need not be replaced. Similarly, foundations generally survive a casualty loss and are not necessarily included in the replacement cost calculation. Significantly, if the association doesn't provide replacement costs, a unit owner is not permitted to purchase gap coverage. Gap coverage would be insurance purchased by the owner to make up the difference between the association's policy and 100% replacement cost. FHA will not accept this. It is the association's responsibility to insure to this level, and I would venture to say that even without the FHA requirement, most insurance, management, and legal professionals would advise that an association have this coverage anyway. In addition to the property coverage, the association is required to maintain CGL coverage, which means comprehensive general liability. This coverage ensures all the common elements, any commercial space owned and leased by the association, and public ways, which include streets, roads, and walkways of the condominium. There must be a minimum of $1 million in coverage. If the master policy does not include interior unit coverage, including interior improvement and betterments coverage, the unit owner is required to obtain a walls-in policy, which is commonly known as HO6. HO6 policies are also known as condominium owners policies, and they generally cover personal liability, damage to personal property such as furniture, computer equipment, and clothing, interior walls and floor coverings. They fill in the gaps where the master insurance policy may not cover a particular loss or there is a deductible, and it definitely provides coverage for improvements or upgrades, that is, improvements and betterments. Since most master insurance policies cover only the original condition, yours may differ, but most cover what we call builder grade, the original condition and value of the unit, and non-improvements and betterments. It is likely that most owners will be required to obtain HO6. And in my view, this is a good thing. This is positive for the association industry and provides recognition that master policies do not cover all interior damage as well as personal property within units. For many years, banks have accepted proof of master insurance policies as evidence that the unit was properly covered. That just isn't so, and this FHA requirement is a welcome change. Master policies covering multiple condominium projects is not acceptable. However, we have had experience where there is a project which contains a master and sub-condominium associations covered by a single policy, and approval has been obtained. But it meant getting endorsements so that we proved to the FHA that the particular association in question had 100% replacement coverage, had all the appropriate coverages. One of the troublesome areas of insurance has been the fidelity bond coverage. It's also known as crime coverage or crime insurance. It is required for all projects with more than 20 units, and here's the formula that Phil talked about. It must be in an amount equal to 3 months condominium assessments plus the replacement fund balance. The replacement fund balance is indicated on your balance sheet, unless state law requires a different limit. New Jersey law does not mandate a specific amount, so it is the 3 months plus reserves. This insurance, the fidelity bond coverage, must cover officers, directors, and employees of the association together with all other persons handling or responsible for association funds. It has been my experience that many associations do not have sufficient limits to meet this requirement. In fact, I recently attended a meeting at a large-scale association where a discussion of the fidelity bond coverage took place. The coverage was nowhere near the 3 months plus reserves, but the insurance agent for the association actually gave the opinion that it should be enough because the association had internal controls in place, such as requiring 2 signatures on each check. FHA is not interested in these safeguards. They want the 3 months plus reserves. Beyond the limits of coverage, the issue of providing fidelity coverage for managing agents has created some problems. The FHA guidelines originally mandated that the managing agent had to maintain a separate crime policy. This would have been a duplication in coverage and expense, and contrary to state law, in certain states which require that the association must provide coverage for the managing agent. The FHA has relented to a degree and now will allow the association to provide the coverage provided that the policy must name the management company specifically as an additional insured. In other words, while most policies include the managing agent generically as a category of named insured so that if an agent changes, there's no issue with the coverage, the FHA wants to see the name of the management company. The management company itself has to be covered. For some reason or no reason at all, the FHA has imposed this requirement, and it is my understanding that the CAU and perhaps others will provide such an endorsement. But my own feeling is that the insurance companies should simply provide an endorsement to name the specific management company as an additional insured together with any successor managing agent, and that will solve everybody's concern. Maybe Phil later on during the question period can update us on the CAU endorsement. Flood insurance. Flood insurance is another coverage addressed by the guidelines and must be provided for any property located in the 100-year floodplain. This is not new. It was a requirement imposed by 2 previous mortgagee letters, one in 2009 and one in 2010. Coverage must equal the replacement cost of the project less land costs, or the National Flood Insurance Program standard of $250,000 per unit, whichever is less. In other words, the association's policy limit must be the number of units in the building times 250,000, not to exceed the building's replacement cost, so that if the number of units times 250,000 exceeds the building's replacement cost, it is the lower number that applies. This is for each unit, irrespective of the elevation level of the floor on which the unit is located. We always get questions about mid or high-rise buildings. Units on higher floors above the flood level still need to be insured. The association, not the unit owner, is responsible for obtaining adequate coverage, and the flood insurance must protect the interests of the borrower, the unit owner, as well as the common areas. Gap coverage, not acceptable. The association has to provide this coverage. Now, there is some relief. Potentially, if your property is on a FEMA map within the special flood hazard area, you can apply for one of 2 letters that the FEMA would issue and does issue. One is a final letter of map amendment, LOMA, and the other is a final letter of map revision, LOMAR. These documents have the effect of changing the flood designation. If you can't get either of those, one final alternative is to retain a licensed engineer or surveyor to take measurements and document that the lowest floor, including the basement and related improvements and equipment essential to the value of the property. That means if you have an air conditioning plant outside that's lower than the basement floor, that has to be taken into consideration. But if you get one of these elevation certificates that all of that is above the 100-year level, you will not be required to get flood insurance. That concludes the review of insurance requirements. we now turn to a favorite issue of mine, which is the issue of disclosure and liability. Bill has already made us aware of 2 disclosure requirements relating to litigation and special assessments. There are certifications that are required to be signed and submitted by lenders when they're involved in the DELRAP process, and those are beyond the scope of today's presentation and probably not of much interest to today's audience anyway. But there is one certification, the project certification, that has many of us quite concerned and should be of interest to everybody here. I have reproduced the project certification in its entirety in the slide that you are now looking at. As you read it, you will appreciate how scary it really is. First, it requires the signer to state whether they have knowledge of circumstances or conditions that might have an adverse effect on the project or cause a mortgage in the project to become delinquent. The circumstances they have in mind would include such things as construction defects, which is somewhat straightforward, but also includes dissatisfaction amongst unit owners and disputes concerning owners' rights, privileges, and obligations. A number of attorneys are advising their clients not to sign this simply because how does a manager or board member make an evaluation concerning dissatisfaction amongst unit owners or disputes concerning rights and obligations that might have an adverse effect on the project? And what does an adverse effect really mean? That people are arguing in the streets, or does it have a job of defining what they're looking for? Circumstances exist which would cause someone to stop paying their mortgage. We can figure out what it means. And if that isn't bad enough, there is a continuing obligation to inform HUD, the Department of Housing and Urban Development, of any material information in the application that is no longer true and correct. Yes, if circumstances change in the future, you have the obligation, or the signer of the certification has the obligation to inform HUD of any circumstance that is no longer true and correct. So you have to be aware of what is in the application package, and if there is a material change, you need to remember to advise HUD. This is quite a burden. And if you look at the next slide, the guidelines remind submitters that a federal criminal statute, Title 18 U.S.C. Section 1014, provides that knowingly and willfully submitting a document with false statements to a Department of Government is a criminal violation and can result in a substantial fine and imprisonment. And I think you would agree that both those numbers are substantial. You just don't want to get this one wrong. But at least there's one solution, and Phil and perhaps others in his line of work will sign the certification for projects that he submits, provided that the association provides Phil with a signed questionnaire answering questions that make him comfortable signing off. My final topic is the anticipated FHA regulation concerning transfer fees. To understand the context of this issue, we need to start with the discussion of the Federal Housing Finance Agency, the FHFA. This organization was created by Congress in 2008 in reaction to the mortgage debacle. Its purpose is to regulate Fannie Mae, Freddie Mac, both of which were in trouble at the time, as well as the 12 federal home loan banks. These entities, Fannie, Freddie, and the home loan banks, are referred collectively to as GSEs, or government-sponsored enterprises. The attack on third-party transfer fees began with the FHFA. That's why we're discussing it here. A transfer fee is a fee paid on the sale of the unit. The reason that they came under attack, these transfer fees, is because some housing developers in other parts of the country primarily were using a new method of funding infrastructure costs. They would borrow the money from a funding source, and it would be paid back over a long period of time by fees paid to the third-party funding source on the transfer of homes. For reasons that may be obvious, but are beyond the scope of our discussion today, these third-party transfer fees came under attack by regulators, and association capital contributions and membership fees became caught up in the controversy. So now we have a question.
Yes, we have our third and final polling question for the audience. I'd like you to again chime in on where you stand in your situation. I know we have a lot of management companies, so managers. So if you're managing a single project or dealing with the majority of your projects, please answer this question. What types of transfer, resale fees, does your association have? Okay, it looks like the overall majority is the working capital membership fee based on a number of months. And close second is based on a set dollar amount. I don't seem to have the issues with percentage of purchase price, which I know is a concern. Ron?
Thank you. Okay. What are transfer fees? And these are examples, those required to be paid on the transfer of units. And as I said, the association fees are in contrast to the third-party fees paid to these developers or funding sources. Now, initially, the FHFA banned the GSEs from purchasing any loan for a home, including a condo or HOA home, for which there was a transfer fee of any kind. There was a public outcry, including from our industry, that this was much too restrictive, and the FHFA went through a rulemaking process, which under the Federal Administrative Procedure Act requires the taking of public comment. And boy, did they receive public comment. CAI took the lead in advocating for association transfer fees, and as a result, in the final rules, which become effective next month, July 16th, as a matter of fact, most association transfer fees have been protected. Here are definitions from the FHA regulation, but I don't want to spend a lot of time on them. A private transfer fee is the payment of a fee to a covered association, and the definition of covered association will be in the next slide. And it provides a benefit to the covered association. It's a non-profit mandatory membership organization, and in short, I will tell you that these definitions apply to virtually all of the associations that I've come in contact with in this state. So for the most part, associations in New Jersey will pass muster in terms of their transfer fee with regard to the FHFA. But the real issue for today is that the FHA has indicated that they are going back to the total ban, ignoring the extensive public comment that was received by the FHFA and refusing to go through its own rulemaking process under the Administrative Procedure Act. The bottom line is there is still work to do on this issue with the FHA. We won as far as the FHFA, Freddie and Fannie, and the home loan banks, but we still have to work on the FHA to convince them, in my view, number one, they should really go through a rulemaking process so that they can take public comment, and number two, that they come to their senses and see that there's actually a benefit to association transfer fees that are totally different from the third-party transfer fees that caused the controversy in the first place. And that ends my presentation. Back to Ed. Thank you.
Thanks, Bill and Ron. A lot of information there from all of you, and we've actually gotten a lot of questions. We're going to go through those questions. I do want to mention first that the complete presentation will be available on our website soon after the program is over, and you'll be able to revisit it, so you wouldn't have to take detailed notes of what you were listening to today, as it should be there. I'm going to go over a couple questions that came in. We have some time. And one of the questions that came in deals with the cost to obtain the yearly renewal once the original is done, or what's required on an annual basis. How long is this approval good for?
FHA approval, once it's issued, is valid for 2 years, at which time it has to be recertified. There is, again, a recertification process if you wish to remain on FHA's list. FHA does not charge any fees. I guess we'll call that the last great bargain left in America. Costs for our services, for example, and I'm not doing this as a commercial, but just as an indication. Current fee we charge, if it's a new project that we're working on, is $2,000. It's a one-time flat fee. And to do a recertification in 2 years, if we did the initial certification, our current policy is that we charge 50% or $1,000 of the usual fee just to perform all the updates. That is what our current fee structure is. I'm certainly not going to guarantee what our fee structure is 2 years down the road, but that's what it is currently.
Another question, question I also had after listening to this for an hour, is what legal responsibilities would a board have in going through all the work and putting this together? Is there any legal fallback on the board members or the association? I mean, Ron, you could talk about that in a minute?
Yes, we're asked the question all the time, is there a legal obligation for a condominium board to seek FHA approval? And there is no law that requires them to do so. However, the concern that those of us who advise associations have is that there may be a fiduciary duty, since FHA loans occupy such a large portion of the market these days. The association exists in part to maintain the values of the homes and indirectly to see that they remain marketable. And by excluding the possibility of FHA financing and closing off the market to a substantial population of potential purchasers, someday I think that some smart owner will file a claim saying that failure to provide approval or at least seek it is a breach of fiduciary duty. Now, you have to do a preliminary analysis as to whether the association even qualifies. If consulting with your lawyer and managing agent and accountant and maybe somebody like Phil, if the association simply doesn't, because, for example, of your affordable housing provision, if you're not going to get it, you don't have to go through the expense in the process.
This is an interesting question I also was thinking when you were going through. What constitutes a delinquent unit owner? Is it a late fee for $25, or is it the equivalent of a month's maintenance fee? Maybe you could answer that, Phil.
Delinquencies are based on unit assessments. Late fees and other charges don't apply. So they're looking specifically at monthly assessments that are past due more than 30 days. Where CAI, I mentioned earlier, is looking to extend that to 60 days, is that, quite frankly, there are some people who pay at 31 days. It just, the nature of the beast, people will pay up until the last minute, and a lot of times it really is a function of when the delinquency report is being run and being provided. If you provide it on the 13th of the month, it may show a higher level of delinquencies than if you run it on the 18th of the month. And so at the time of submission to FHA is when that delinquency assessment has to be certified to. And so we do have situations where someone who's more than 30 days all of a sudden is no longer over 30 days a week later.
This is a question I get a lot when I go to board meetings and ask whether or not the association started the FHA process. How do the boards need to think? Their concern is they want owners in there that are going to pay the maintenance fees. If they're if they go ahead and get FHA approval on the project, is that going to automatically allow people that can't afford to live there to move in? I mean, it's a subjective question, but is there any statistics on this that either one of you guys are aware of?
I will only go on record as saying that this isn't your grandfather's FHA, number one, and number two, FHA, unfortunately, to a lot of people, they equate that with Section 8 housing, which it's not. The reality is, even during the heyday of the subprime, no income, no asset type mortgages, FHA has always been a full doc loan, and lenders are held to a very high standard for approving buyers under the FHA program. It could be argued that people under the FHA program a few years ago were probably more qualified than half the other people who got in your condominium under a no income, no asset. But the reality is while I don't have statistics on foreclosures and other delinquency information, I would probably be very comfortable in saying that the delinquency and foreclosure numbers for FHA are no worse than what it is for the conventional loans.
On a reserves, those that go out and get a full reserve study done, and the reserves happen to be 10%, less than 10% according to the study. How often does the study need to be updated?
Reserve studies are valid. What's considered a concurrent reserve study is a reserve study that was completed within the last 2 years. So if you have a reserve study that was done in 2005 or 6, while that reserve study may have been based on a 20-year projection, FHA will not allow you to use that reserve study as the basis for filing a budget that has less than 10% allocated to reserves. I will go on the record as saying that the current policy with FHA is that as long as your budget includes a allocation of 10% towards reserves, and by the way, reserves and deferred maintenance both fall under that same category for purposes of that 10%. So if you have a budget that shows 2 different line items under reserves, long-term and deferred maintenance, both of those go into the calculation. If you're over the 10%, you don't need a reserve study for purposes of project approval eligibility. Having a reserve study is always a good, smart thing to do nonetheless, but it's not a mandate with regard to FHA approval. The only time you need a reserve study if it's less than 10% of your annual budget, and you're using that reserve study as the justification for allowing that.
You know, is there a website where an association can go to see which associations are approved? Somebody could put it up there.
Yeah, there is a website. It's contained in the guidelines, but you can check to see if your project is approved. But if you haven't received an update or project approval within the last 2 years, you're not up to date. There's no way that your project continues to be approved.
Yeah, we did note that there's a lot of projects that have fallen out of the approval in the last couple of years. The list that came out.
I mean, in the simple way, I mean, there is a link to the condo website. If you go to HUD.gov, and I can't remember exactly how it's listed, but over towards the right of the website page, you can click on and it'll go down and lead you to approved condos, or just go to HUD.gov and type in approved condos under their search engine.
Okay, also if you want to email any of us, we'll send it to you. There's a question here, what if a developer retains 10% of the units? Is that project still potentially able to get coverage?
Yes. Well, subject of qualification. A developer in the sellout of a project obviously is the owner of unsold units. Those don't count towards the 10% rule. What FHA does count in the 10% to one owner rule is that the developer owns more than 10% of the units and they've rented them. If they are subject to tenant occupancy by the developer, which a lot of developers did over the last couple of years during the market, they have been renting units in order to generate cash flow to pay their construction loans and so on. Under current FHA policy, if you have a developer who owns more than 10% of the units and those units are subject to tenant occupancy, the project would not be eligible.
Here's a question on fidelity insurance coverage. What if the management company has their own fidelity insurance? Does the association still have to have management company named as additional insured?
I believe that a standalone policy covering the managing agent is what they originally asked for and would be accepted.
Okay, cool.
If by the way, the limits still apply.
The limits still apply.
And that's the big question mark. If it's a management company policy, it's still 3 months assessments plus reserves. It's big numbers.
How does the changing of board members, property management changing to a new management company altogether, how does that affect your certification and anything else that you need here? I would assume you need to have the insurance certificate in place. I know there was a whole controversy with the insurance certificate and who's named in that, and with property managers versus property companies.
That was the argument that CAU made, that naming a management company specifically, XYZ management company or whatever, was a dangerous thing to do, because when management companies leave, as they sometimes do, and during the interim time while the board is interviewing and hiring a new management company, technically you don't have any coverage at that point in time. So the reality is that a change in boards and things of that management companies they're fairly routine. You just have to make sure that your fidelity or crime coverage is kept up to date in terms of who's named as an insured on the policy if you're using that route.
This is a good question. If the community was supposed to be 5 phases, and only 4 phases got completed because the builder went bankrupt, can they still qualify under a situation like that?
That's probably a question that's not easy to answer in this particular venue. When you're dealing, if the bankruptcy was discharged from the original builder several years ago, FHA does have a provision in their guidelines that allows for the submission of a project where there was a bankruptcy of the original developer, as long as the bankruptcy was settled more than 1 year ago. In the case of a project where the additional phase, say 5th phase of a project, never got built, isn't intended to be built, and is going to be looked at as a fully completed project at 4 phases, I'm sure there's probably documentation that could be provided to satisfy FHA. And I just want to interject one thing. I know we're running low on time, but that's an important aspect in that FHA, under the current FHA guidelines, the maximum number of insured FHA loans that you can do on a project is 50% of the project. However, the exception to the 50% rule, which goes up to 100% FHA insured loans available in the project, is for fully established resales only, no further annexation type projects. So if you have a document that says that there's additional phasing that's permitted, technically you wouldn't be eligible for that 100% exception. So you'd have to go through some a little bit of additional documentation with HUD.
Okay. I asked this question originally in preparing for this program. The FHA applies to both condominiums and HOA projects, but you don't have to qualify an HOA association. It's qualified on a house-by-house basis. Is that how it works?
The homeowner associations, each home is treated as a single-family home. The project guidelines are only for condominium projects.
A transition lawsuit against a developer, is that automatically a violation of FHA standards?
A transition lawsuit, FHA's position, as we've experienced, is that they will not approve the project until the lawsuit has been settled. And if there's any defects in workmanship, that was the purpose of the lawsuit. If there's been any defects in workmanship, any work that's been outlined has to be completed. They will not accept a project where there's ongoing litigation against a developer due to defects in workmanship.
Just a question, is there a concern with the number of low to moderate or Mount Laurel units in a project? Is there a concern with the percentage that it may? We got a question from somebody that's a complete 100% low to moderate income community.
As long as the restrictions terminate in foreclosure, it wouldn't be a problem. But if the restrictions don't terminate in foreclosure, and the problem with those types of affordable housing restrictions is that they can vary county to county and municipality to municipality. If they don't terminate in the event of foreclosure and your project is 100% affordable, then the project's not eligible for FHA.
Phil, when you were talking about the arrearage list, can they pretty much give an arrearage list at any time during the month? Does it have to be a certain time of the month?
There's no specific time of the month that we get it, but that goes back to the issue of the 15%. You can be over or below any time during a particular time of month.
Any idea, stat-wise, how many associations go after the FHA approval versus don't? It's hard to.
I have no idea.
I think it's a concern for everybody right now because of the high percentage of loans coming out.
But I have seen material from the FHA remarking about how many associations that were formerly on the list have not applied for recertification. It's a rather large number.
It's, at some point a couple of years ago when they first compiled their list, there was over 40,000 names, projects that were on their status listing. And according to HUD, and this is going back to April when I was at a conference with them, I think they said there were somewhere in the neighborhood of 8,000 that had recertified. So there's a significant number of projects that either were at one time on their list but have since are now shown as expired.
I think we're going to do one more question, and then everyone, if you do have questions after this, you can email us at info@wgcpas.com, and we'll either answer it ourselves or direct it to one of the speakers, and they'll email you back with an answer. Okay, the last question we're going to talk about is, and I've had this question at board meetings, if a receivable, somebody hasn't paid for months or years and it's deemed to not be collectible, how can it be handled with regard to the delinquency list? Typically as an accountant, we don't like to see things written off until either there's a foreclosure action or there's a bankruptcy, something that defines an event where it actually is, you're not getting the money. I know one of the latest techniques, and Ron, you might want to address this, is the going after money judgments, which are good for X number of years, even beyond the unit turning over.
Well, yes, but the issue for FHA is whether a given unit is producing income for the association. So you can write off all you want, but if you write off and you're still not collecting the assessments from that unit, it still goes into that calculation. So just writing it off, if you write off an old debt and you have a new owner in, then the FHA will view that favorably. Right. But if that unit is, let's call it non-performing, that goes into 15%.
So again, that's part of the 15%. Even though you write it off and it's delinquent, you're not getting revenue from it, you need to count it in the 15%.
And remember, it's not the dollar amount, it's the number of units. So if you have one particular unit that's $20,000 and you write it off, you've only lowered your delinquency by one unit. So if you still are over the 15%, you haven't accomplished what you want to accomplish. If you're under the 15%, the dollar amount's again not relevant. You write it off all you want, as long as you're under the 15%, you'd be fine.
Okay, well that concludes the seminar, and again, it's available on our website. And also, again, if you have additional questions, you can contact us at info@wgcpas.com. We thank you all for attending and appreciate your time. Thank you.